Hey, welcome back. Getting back with the monthly portfolio update. May was overall a very good month for the portfolio despite not the best earnings, a lot of market uncertainty, but quite a significant dividend. The only thing I added to the portfolio was a bit of Warner Bros. I made an updated analysis recently and I still think it's among the best opportunities in the US right now. They reported some actually good earnings, but Q1 is usually the slower one because of the way the business works. In Q2 they'll already probably do much better thanks to Minecraft being a blockbuster, but we'll see in a few months. Again, I think this has huge potential and just continuing to repay the debt and then switching to some dividends or buybacks could be enough to see a multibagger, as I mentioned in the analysis. The dividends were very significant, around 1% of the total portfolio, so that definitely helped the performance. Most of it was from Stellantis, despite cutting it quite a bit, but also Nokia, Verizon, Realty Income and a bunch more. And about that, would you like me to maybe show you only a core portfolio with 10-15 companies instead of more than 30 positions? It's probably easier for you to follow and especially see as well. I can just not show what's below like 2.5% of the portfolio, and that's like more than half of it. And if you want to see the full portfolio at any time, it's always public on eToro and you can check it for free without even having an account. You know, I'm not trying to hide any stock from you and you can just ask me about any company at any time. It's also easier for me to show and go through some of them each month depending on what's happening. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. It wasn't the most eventful month, but rather a rebound from what happened in April, and it was one of the best months of May for the S&P ever. Instead, I wanted to hopefully teach you something new today, and for that I want to mention Adecoagro, my number 1 position. They are a farm and agriculture commodity producer with land predominantly in Argentina and Brazil, focusing especially on sugarcane, which is symbolic for Brazil. They also have the facilities to turn it into ethanol, which is used in and as fuel, and do whatever is more profitable at the time. They recently had Tether, the guys behind the stablecoin with the same name, buy another 50% of the company, owning about 70% now. What's interesting is that they bought it at more than 12 and the stock fell even below 9 after it. A main reason why they fell, which is what I want you to remember today, is the crash in oil prices. You may be inclined to think that's good because they need fuel in planting and processing, which is true, but there is a very important aspect to keep in mind. Instead, they fell because sugarcane is used to make ethanol, being probably the most efficient way to do it, several times better than corn, which is what the US does. When oil goes up, ethanol or higher ethanol content gas become a more attractive fuel, especially in Brazil where it's much more predominant. Then demand rises and the price follows. When oil prices fall, ethanol has to follow because if it remains high and oil goes down, then you don't have the same demand. In turn, companies like Adecoagro may decide to produce less ethanol and just make sugar. But then you have more supply and the same demand, so prices eventually have to fall regardless. An article I see from 2020 even showed a correlation of 0.9 between sugar and oil, with one being basically perfect and almost impossible to see in reality, although long term it's much more moderate. You know, sugarcane is a crop and you can't just reap and process it at any time. It depends on the environment, rains, droughts and so on, but what I wanted to show you is that commodities are much more complex than they may seem. This is also a reason why ADM fell, with corn and oil having about a 0.6 correlation, but we'll look into them very soon. Another reason why I wanted to mention Adecoagro is because when looking into them recently, I found another company that's very similar but might actually offer a better opportunity now, Brazil Agro. Similar crops but with a focus on soybean actually, healthy, trading around equity, a lot of land but much smaller and seems like it might be cheaper, plus I'd like to diversify a bit. Plus the very nice dividend, even if it was cut recently and it's likely to see them cut it again in the near future depending on the environment. But you know, it's Brazil and you have to be a bit more careful. I still have to look into them, but maybe you can check them out too if you're interested. I started publishing analysis on Seeking Alpha at the end of May and I'll eventually publish it there. We saw some news about a deal with China that was later breached and the tariff uncertainty just continued. Again, I think it's all about negotiating some better deals for the US rather than a permanent thing. The same with the recent tariffs on Europe, steel and aluminum. There is very likely a bigger plan behind it. But again, the effect that it may have is weakening the market's confidence in the US. Political risk on top of economics and everything is something that the market takes into account when valuing a country. And somewhat related, another thing that happened was the US credit downgrade, which didn't send that much fear into the market, to be fair. This means that now all of the big three rating agencies have downgraded the US from the perfect rating. I don't give that much importance to these agencies, but we might see the US entering into a debt repayment period. If they want or manage to devalue the dollar, commodities and commodity stocks in particular should have a very good time once again. And I'll mention again that this kind of politics has a negative effect on the market's confidence in the US. So instead of a ratio of 20 or whatever, we may see the S&P at an average of 16, for example. Still relatively high, but a significantly worse long-term performance. And knowing now more than ever that at any time the president has so much power to make the market crash or skyrocket, pension and other funds may look into other assets. At the same time, we could see rate cuts which would devalue the dollar even more, which isn't necessarily bad for the country. It's actually optimal for a debt repayment period, so again, there is likely a plan behind it. If you connect the dots, things make sense from an economic point of view, even if they affect Americans in the short and medium term, especially together with a push for more exports and commodities. But there is uncertainty and we can't know what's next, so the market's confidence is also affected. And we already see US Treasury yields getting higher, so they need to pay more to attract money, which can spiral into even worse issues with the debt. But again, commodities like food, gold, oil, electricity should be something to look into. And what's good is that many of those stocks are actually getting pretty attractive. Even ADM, which I didn't like that much before, is getting above a 4% dividend, so it's on a good path. But we could also get into a commodity down cycle, so it's about balancing the risk and reward you are happy with. For me, as I said in the video, if they fall to like 5–5.5% yields, it's definitely worth considering. And to some degree, even bonds could be attractive as a way to reduce the risk and diversify with an actually good yield. And on the other side, stocks in Latin America and other emerging markets could win a lot from the weaker dollar. Right now, I'd say a few oil stocks are actually getting interesting and I'm considering opening some positions. I made 2 videos last week where I look into the sector, by the way, so make sure to check them out. Stuff like Devon is maybe even good purely as a value investment, I think, on top of the cyclicality. And another interesting industry would be lithium. I saw SQM actually trigger one of my price alerts last week, so I'll have to look into them again. So not some amazing buys yet, but we are rapidly getting there. So overall a very solid month that basically recovered the fall in April, and I'm now back on track to something like 10% this year. Again, really not active with the buys, but a lot of companies are getting to interesting levels, especially in commodities. All the S&P, Nasdaq and especially tech stuff recovered, but keep in mind that gold is still close to all-time highs and oil is still well below 70, so things aren't the same. You know, oil companies will have issues and tariffs are still not over, rates are high, treasuries are falling lately, but debt is still expensive, so I think we might see some opportunities. This is a reason why the stock market and especially the S&P aren't a good representation of the economy. It's very tech focused and there are many other important things that may go under the radar. But again, I have a decent amount of cash ready to take advantage of whatever may come, even if it's not a recession or something terrible. And don't forget to check out the recent oil videos, I think they are very good to watch now. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.